Hello, I'm here today to talk about inflection points for asset managers. The first key question is, what is the major inflection point for asset managers in Australia? Well, in NMG, we always look at the data for clues. So the first piece of data we looked at was how much revenue are asset managers earning in the market. As we can see, Australian asset managers are earning of the order of $10 billion a year in revenue from active management services. That's a very considerable number, well over $1,000 per Australian resident. And we know that asset management is a highly profitable market. 30 to 40% profit margins are achieved by many participants in the market. So $3 billion or so of profit per annum. There's not a clear burning platform. There's not a clear inflection point when we just look at the current situation of the market. So we look deeper at some additional data for some extra clues as to where this inflection point may be. This chart here shows the Australian retail market over the last 30 years since the introduction of the superannuation guarantee in the early 90s. We can see from the left-hand side of the chart a consistent period of 15 or so years of steady, consistent inflows year on year, which was at a time where asset markets were generally rising. Again, a positive place to be. But the clue is on the right-hand side, since the GFC, where there has been growth, but has been less obvious and less consistent than in the earlier period. So maybe there's an inflection point starting to appear around the growth in the market. If we narrow our focus down to the most recent decade, our inflection point becomes clearer. In this case, we're looking at the superannuation market in Australia, and we can see the net organic growth rate in percentage terms. At the start of the decade, this was running at around about 4% and has substantially slowed down, partly as the overall pie has got bigger due to compounding of returns, but more so as inflows have slowed down in a net sense, both in terms of lower contributions and increased pension payments as the demographic has aged. Our inflection point is now clear. The Australian investment management industry is facing a slower growth future. Okay, so we now have our inflection point, which is slow growth. The key question which then faces us is what to do about that situation of slow growth. How do we compete? Really, there are three broad approaches which could be taken. One, focusing on our core markets, working out how we can compete more assertively and aggressively and successfully. Secondly, thinking about dividing the market into the subsegments which it comprises and looking for those subsegments where there is quicker growth than for the average, because there are segments that are growing more quickly than others. Or thirdly, we could position ourselves for the future to create an innovative and bolder strategy that gets ahead of where the market will be over the next 10 years. So how should managers compete more successfully in their core markets? Well, there's always going to be a place for an investment manager delivering top quartile performance in relevant categories. That's always going to be a successful approach. But by definition, it can't be successful for 100% of managers. We would argue managers should focus on controllable commercial aspects that deliver an all-round experience to their clients. In terms of distribution, organizing yourself most effectively for the new hybrid or more digital world we face into. Using data better to deliver more targeted marketing messages. Thinking about creating more compelling and interesting messages in client reports to allow investors, advisors, to get a greater insight from what you're doing as a manager. All of these controllable factors will add up to a more compelling proposition in your core markets. The next approach is to think through carefully where are the pockets of growth where your firm is best positioned to exploit. This chart here shows some of the more obvious pockets of growth we've seen over the last few years, and each of which we expect to continue to be pockets of growth for the next at least 5, possibly 10 years. We all are very aware of the growth of ETFs. Australia is probably still 5 years behind markets like Canada, so we expect this growth to continue well into the $200, $300 billion category, both in terms of growth of passive assets and active. ESG is a theme we're all familiar with. Almost every conference on investment management contains ESG as a topic nowadays. Interestingly, within this, we're seeing a rotation from the more traditional negatively screened ESG products to more positively screened and impact and fully integrated ESG. So even within ESG as a category, there are stronger growing parts within that subsegment. And thirdly, on this chart, managed accounts, we've seen strong growth, which has enabled advisors to add efficiency into their practices. These are three pockets of growth. They're not necessarily the three that will be best suited for your firm. I could equally have put up here global equities, private equity, other forms of pockets of growth within the market. The point being, there is likely to be a pocket of growth which is well suited to the capabilities that your firm has.